We're on to section B now of the 2023 paper one. We're looking at question 14, which is Rexarol PLC. The questions in section B, there are two of them, two 20-mark questions that are split 14 marks for computational work and 6 marks for writing. So we're going to look at this one, the statement of changes in equity, which is what we're being asked to do for a company called Rexarol PLC. And we've got a whole load of information. So I'm just going to go through and explain what it all is and what we need to do with it. And then we're going to do some workings. We're going to need some serious workings for this one. And they've given us lots of space, half a page there and a full page there. And they fully expect us to use it. So let's do so. All right. So the opening balance is then 1st of April 2022. It does actually tell us they were opening balances. The share capital was £1.4 million. Now, the first thing I would be looking for is to see what the nominal value per share is, because whenever we're doing dividends or rights issues or bonus issues, we always need to know about the number of shares that are in existence. And unless they're £1 ordinary shares, it won't be 1.4 million. And we can see here that the nominal price per share is 25p. So I'd be thinking to myself, well, how many can I buy to the pound? I can buy 4 to the pound. So if I multiply 1.4 million by 4, that means I've got 5.6 million shares. The other way to do it is to divide by 0.25. Do not multiply by 0.25 because you'll get a very small number, 350,000. So that would be completely wrong. We need to gross it up. So we get 4 to the pound, they're 25 pence shares. The share premium, 6.30, has been brought forward. This is a capital reserve that would have arisen when they issued the shares at a premium. So they sold them for more than the 25p. Now, because this is a capital reserve, it's very limited what we can do with it. We can't pay dividends from it. All we can do is convert that into bonus shares. And we'll see in a minute that was done during the year. So the following events have occurred during the financial year. So on the 30th of June 2022, they made a bonus issue of 2 new shares for every 5 shares held. So we're going to work out number of shares. So 2 over 5, convert it into a fraction, and times it by the 5.6 million to find out how many new shares we've got. So 2 over 5 times 5,600,000 is 2,240,000 new shares. Okay, and we'll come back to that in a minute. They just issued at a price of 25p. So if we times that by 25 pence, that means the value of that issue is £560,000. Okay, we've paid a final dividend of 7.5p for the previous year on all shares in issue at the 1st of April. So that dividend of 7.5p needs to be converted into pounds because that's the denomination that our accounts are done in. So don't multiply things by 7.5. And we're going to be multiplying that by the 5.6 million shares that we had in existence on the 1st of April. So the bonus shares won't qualify because they were issued on the 30th of June. The next thing that happened then on the 20th of January was that they made a rights issue. Now, a rights issue is where we sell shares to existing shareholders. 1 new share for every 4 held. So we need to make that into a fraction and work out how many shares were held. Well, we had 5.6 million at the start, and we've done another 2,240,000. So it's times 5,600,000 plus 2,240,000. So 5,600 plus 2,240 is 7,840,000. I'm just going to squash that in there. And we're doing a rights issue of a quarter of that. So it's 1,960,000 new shares. Okay, and we're selling those at a premium. So a premium means the extra on top of the nominal value. So remember, the nominal value is 25p. So each of these shares would have been sold for a total of 45p. We'll come back to that in a minute. We're just interested in the number of shares at the moment. So on the 15th of February, they made an interim dividend of 2p per share, and it was paid on all shares in issue at the 31st of January. So that's going to include the 5.6 million, the 2,240,000 and the 1,960,000. So again, we're going to convert that into a pound amount, and we're going to multiply that by the total of 5,600,000. I'm going to run out of room here, plus the 2,240,000 plus the 1,960,000. £5,600,000 there. So the total of that lot, 5,600,2240 and 1960, means that we had 9.8 million shares, and they each got a dividend of 2p. Okay, and we'll work that out in a minute. We'll sort the dividends out. Now, the 31st of March, a dividend of 8p per share was proposed. Now, if something is proposed, it's just an idea that's put forward. It was proposed by the directors, and it would have been proposed to the AGM, the annual general meeting of the shareholders, for the year ended 31st of March 2023. Now, the AGM wouldn't have happened until well after the end of the year, when the accounts were available to present to the shareholders. So this dividend won't be paid until partway through the following accounting period. It's a bit like this final dividend here. That would have related to the previous year, but we're interested in it because it's been paid during the year that we're dealing with. But this one we can completely ignore. It's what we like to call a red herring. It's just something that's put in there to test whether we can discriminate between things we do need to deal with and things that we need to ignore. So this is clearly something that we need to ignore. And the reason for that, I'll just write that there to remind us, it's proposed, not paid. So if it hasn't physically been paid during the year, just ignore it. Okay. 31st of March 2023, so right at the end of the year, property is revalued to 1,950,000. It originally cost 1.8 million, so it's increased by 150,000 on the original cost, but it's been owned for 5 years at the time it was revalued, and it had been depreciated at 6% per annum using the straight line method. So the carrying amount, or the net book value, is going to be considerably lower than £1.8 million. So that means that we're going to need to increase the value by quite a lot more than just 150,000, and we'll come back to that in a second. So additional information, let's just check through here and see what we need to do with it. So we've already dealt with that. The nominal value of the shares is 25p. Note number 2 tells us that the directors maintain the reserves in their most distributable form. Now, most distributable means ones that we can pay out as dividends. So the only one that is distributable is the retained earnings column. It's this final column here. We haven't got a total column in this statement of changes in equity. The examiner has decided not to give us that, to kind of double check the casting across here. But that's fine. We can just deal with each column in turn. So that just means that if we do a bonus issue, it needs to be paid wherever possible, paid for from the share premium, and if we need to, the revaluation reserve. So we should try and avoid using the retained earnings where possible for things like bonus issues. The draft profit from operations for the year to March 2023 has been calculated as £1,858,000. This figure includes an accrual for legal fees of £292,000, which is no longer required. Now, remember, an accrual for an expense, which clearly is what legal fees are, would have reduced the profit because it would have increased the expense. If we no longer require it, then we need to add it back. So the profit is going to be £1,858,000 plus £292,000, not minus. If we were asked to make an accrual for legal fees, then we'd be reducing profit, but we're not. We're being asked to reverse one out that shouldn't be there. They've decided it's no longer required. So we're going to add that back to the profit. It says here that no adjustment is required for depreciation to the profit from operations. So the figure we're being told about, or the depreciation information we're being given up here, is just so that we can work out how much our property has increased by. So they've already sorted out the depreciation. We don't need to worry about that. So that's fine. At the 1st of April 22, Rexarol PLC had a 6% debenture. So 6% debenture is an amount that's owed. It was £550,000 that was repayable in 7 years' time, because we're doing 2023's accounts. So that means it's a non-current liability. The 6% bit means the interest that's due. So we pay interest of 6% on £550,000. And because it was outstanding for the whole of that financial year, we should have paid interest of £550,000 times 6%, which is £33,000. So remember, that would be a deduction. The finance costs would be deducted from the profit from operations when we're getting to the profit for the year, which needs to go on to this statement of changes in equity. And then the last bit, the taxation charge for the year has been estimated at £708,000. So we're going to need to include that in our accounts as well. So when we put the profit in, it should be the profit for the year after tax. So that's after tax after finance costs and certainly after this accrual has been adjusted for. Okay. So let's have a look and see how we can fill this in. So broadly speaking, we're going to stick to the date order that's gone in here, but we don't want to write dates in here. We just want to write things like issue of shares, so a bonus issue, a rights issue, the profit for the year, any increase in the revaluation reserve, dividends paid, and we need to make sure that we get them in the right columns. So let's make sure we do that. Just give it a little arrow there. So let's start with the bonus issue then. So we've got a bonus issue. Let's just write bonus issue in the left-hand side here. And we're going to make that working number 1. So I'm going to put that down here. So the bonus issue, actually, let's make this working number 1 over here because we've already done the workings. The bonus issue was 2/5, 2 shares for every 5 held, times the 5.6 million that we've already got. So it's 2,240,000 new shares at a value of 25p, just at the nominal value, £560,000. So we're going to put that in there, and we're not going to put the zeros in, remember, because it's abbreviated to the nearest thousand. And then we need to take it out of the share premium. And remember, there's no total column. If we were doing a total column, and I'm going to be really naughty here and write outside the box, the total here would come to 0 with regard to a bonus issue. It doesn't change anything overall. All it does is convert the share premium. In this case, we could also use the revaluation reserve if there'd been one at the start of the year, to convert that into free shares to give to our shareholders. So nobody's better off or worse off as a result of the bonus issue. Everyone's proportion of shares that they own in the company is the same, but we've just all got more shares. So the value of the shares has been diluted, but nothing has changed in terms of the value of the company. Okay, now we've got the dividends. I'm going to come back to the dividends in a minute. So let's just put a little asterisk by that one, because we're going to deal with those 2 dividends together in a minute. I want to put the rights issue in first. So the rights issue, we're going to make that working number 2. Now, I haven't done the full workings over here, so let's make that working number 2, the rights issue. Now, we've got to work out how many shares we've got. So it was 1/4 times the number of shares that were already in existence, which was 5.6 million, the original ones, plus the 2,240,000. So we've actually done 1,960,000 new shares. Now, this is going to be split into the 25p nominal value and the 20p premium. Okay, now remember that 25p, we need to convert it into a pound amount, and same with the 20p. So we've sold each share for 45p. So the company would have received 1,960,000 lots of 45p. That would have been debited to the bank account, but we're going to need to split those proceeds between the share capital, so 25p times that figure, and the share premium, 20p times that figure. So let's work that out now. 0.25 times 1,960,000 is £490,000 in share capital, and then 20p per share times 1,960,000 is 392,000 into the share premium. So we're going to add both of those. We're going to get rid of the zeros because remember we're abbreviating it to the nearest thousand. So 490 in there, 392. And if we did have a total column, we would be adding 800. Oops, I've gone off the page there. 882,000 to the total column. We'd also have the total of all these. I'm not going to do that because it's not required, but it's just to demonstrate the impact of these 2 adjustments. They're very different. So the bonus issue is adding to share capital but taking away from share premium, so it's leaving nothing in the total column, whereas the rights issue is increasing both of these, and it is going to involve an increase of 882,000 in the value of the company and also in the bank account. So they debit the bank account and they credit the share capital and the share premium. So the total assets of the company go up, and so does the equity. Okay, so that's how those 2 will work. The next thing we probably should do, I mean, in real life, you'd normally put the profit for the year in. In fact, I'm going to do that. I'm going to put the profit for the year in next, because we don't pay dividends until we've worked out what the profit is for the year. The dividends are coming out of the profit. So I think it makes sense to add profit into retained earnings first. So I'm going to make this working number 3. So the draft profit figure we had, where was the draft profit figure? The draft profit, so profit from ops was £1,858,000, and we got rid of that £292,000 accrual. So we've reversed that. We don't need that anymore. That's going to actually increase our profit by 292,000. But then we've got to pay finance costs. So remember the £33,000 worth of interest, that was 6% of £550,000. So that's 33,000 coming off. And then we've also got some tax to provide for. This isn't the tax paid that we would need to use for a cash flow statement. This is the tax has been estimated for the year. So we're kind of accruing for this tax. So taxation, tax charge, 708,000 coming out there. Okay, so the profit for the year, this is the final profit for the year after tax and everything else, the figure that we can pay our dividends from is going to be £1,409,000. So that gets added into the retained earnings. So remember, retained earnings are profits that haven't been paid out as dividends. So most companies would retain a sizable amount of their profit for the year rather than pay it all out as dividends. Right, next thing we're doing then is the dividends. So let's make dividends paid. And remember, we want one total for all the dividends paid, and that we're only including 2 out of the 3 because one of them was proposed, not paid. So that will feature in next year's account. So note number 4 here, working number 4, we've got the final dividend. So on the 1st of August 2022, we paid 7.5p, 0.075, and that was on 5.6 million shares. So the value of that one, 0.075 times 5.6 million shares, is £420,000. So that's that one dealt with. And then on the 15th of February, we paid an interim dividend. Let's just move that up a bit. So number 5, 15th of February 2023. We paid 2p, 0.02. Now this was based on all the shares. So the 5.6 million we had at the start, the 2.24 million bonus issue, and the 1.96 million rights issue. So by this stage, we've got 9,800,000 shares, all getting 2p. That's £196,000. So in terms of what needs to go into our statement of changes in equity, if we add the 420 and the 196 together, £616,000 is coming out of our retained earnings. We're paying that to the shareholders. Okay, so that's all that happens in retained earnings. We add profit for the year, we pay dividends. If we'd have needed to, we could have used retained earnings to fund the bonus issue, but that would be silly because the only thing we can do with the share premium and the revaluation is to fund bonus shares. So it doesn't make sense to take it out of the retained earnings. Okay, the last thing we need to include is the revaluation. Okay, I'm going to make this note number 5. Let's just do this over the back on the bottom of this page. So working number 5, the revaluation of the property. So the original cost was £1.8 million. Okay, and we're doing depreciation at 6% per annum. So the annual depreciation is £108,000. Okay, it's been owned for 5 years, so let's times that by 5 years. 108 times 5 means that the depreciation is 540,000. So the net book value, or the carrying amount, is 1.8 million minus 540,000, which is 1,260,000, and it's going up in value to 1,950,000. So that means we've got an increase. The difference between the two is £690,000. We don't have to worry about any kind of eliminated on revaluation like we would do if we were doing the schedule of non-current assets. We just need to compare the net book value at the time it was revalued with its new value. So originally cost 1.8 million. It's been depreciated by 540,000 over the last 5 years. It's now worth 1.26 million net book value. Carrying amount is going up to 1950. So the increase is £690,000. So we debit the value of the property and we credit the revaluation reserve. So the revaluation reserve is going up by £690,000. Okay, so that's all the figures in. All we've got to do, and I haven't got a ruler handy, so I'm just going to draw some slightly wobbly lines, is now work out what the balance is at the end of the year. So the balance at the 31st of March 2023. So we've just got to add these columns up. So share capital is now worth 2,450,000. Remember, we're leaving the zeros off. The share premium is £462,000. It was 630. We used 560 to